Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the daily Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, let's welcome Dimitri Pargamonic to the stage. How you doing, Dima?
Good morning, Will. How are you?
Great. So today we're going to look at historical backtest of call options.
Yeah, let me share my screen here. And what we'll do is pick a company, a stock. We'll go to the options chain and then see how we could take a call option and run a historical backtest or historical performance of a call option with similar characteristics. So let's do that by example, and I'm going to pick Google. Let's type in Google at the top, and what this will do is take us to Google's main page. On the left hand side we have a menu. We're going to go ahead and click on options, option chain. This will bring up an options chain for Google, and I'm going to click on this menu to minimize it and expand our screen. And the idea here is that if we're looking at just a particular option, and one of the questions may pop up and that you may want to get a quick answer to as well, how did an option with similar characteristics perform historically? Okay, so let's do by example. I'm going to switch our option chain so viewers have an idea how to do that. And over here on the left hand side, you could see that we have these different option expirations that are available for trading on the exchanges. We also have some information on them about the implied volatility and volume. So let's just go to an option chain. Let's go out to like August 22nd, for example. So I'll click on that, and this will bring up the August 22nd option chain expiration. And we could see here we have all these available calls and puts with different strikes. And let's say we were looking at a particular call here in Google, and we have this 205 call, and we see that this 205 call, it's a little bit out of the money, right? It's 5.6% out of the money. So you could see the stock is $194. This was 5.6% above that. So the strike is, higher than the current stock price. And we also see that there are 20 trading days and 28 calendar days until this option expires. Well, what does that mean is that, where if you have an option that requires the stock to increase by, a certain percentage, and you have a limited time for that stock to do it, what we want to know is, okay, historically, if we looked at these types of options with a similar characteristic, how did they perform? If we looked at a option that was 5.6% above the spot price, and it only had 20 trading days, how did those options perform? So we would have to go and find similar options. Okay, we're not going to find you're not going to find exactly by percentages. We could find options that have the same days to expiration, but something very similar, and track those performance and get some statistics on it. So to do that, we have this backtest, right? Calls backtest. And if we click on it, it expands the screen. So now you see, now we have this bigger screen. And over here, it gives us some summary stats, which we could click on to look further. And what the summary stats does is it really, it gives us kind of like these quick metrics and says, okay, if we look back in history and took all our observations where we could find similar options, 20% of those options by expiration, like if we took it options with 20 days prior to expiration, and the option was the same distance away, 20% of those at expiration were profitable. Okay, meaning that whatever the value was 20 days prior, at expiration, the value of that option would have been higher. So in this instance, if the option is, let's say around, we're going to take the midpoint, like 216, something like that, 217. Well, if the option was $3 at expiration, well, it would have been profitable, right? If it was below, it would be unprofitable. It could be zero, it could be $1, but that would be unprofitable. So this 20% shows us the profitability, or when the value increased. Okay, the value increased at expiration from the 20 days prior. So when we talk about 20%, it's not the full story, because what we know with options is that it's not a where the payoff is the same every time, right? The option could increase infinite, theoretically. So when we look at 20%, it's not the full story, because even if those 20%, if the time that it hits, it's profitable, if the profitability is so high that it offsets all the other losses and then some, then that matters, right? Think about, like, if you were playing a game with a wheel with 10 numbers, and if numbers 1 through 9 pay off $1, but the number 10 pays off $1,000,000 to 1, well, obviously that number 10 makes much more sense, because the payoff is much greater. So the next thing that we do is say, okay, give me all the profits and losses. 80% of them were losers, 20% were winners. Let's add them all up, and then take the average. And you can see here that the average is plus 14%, which says that, okay, there are a lot of them that were unprofitable. Eight out of 10 were unprofitable. But those 20% historically that hit offset that. And overall, the average return was plus 14%. So let's click on that. And then this will go now and load those back tests for us. So now it's getting like the recent data in our database and rerunning this again. So here we have this long call. So this is a long call, and what it's saying is that on average, we had 420 observations. So these are the stats, the 420 observations. If we look at all 420, the average return was 15% with a win rate of 21, 22. And these are the observations. So here, if you hover over them, a lot of them lost 100% of their value. So whatever it was, $2, $3, $1, whatever it was at the start, we lost 100%. We were in finance, we look at percentages, but there were some that were up. You can see here 2,500%, 1,830%, and so forth. So you could see that sometimes in that period, the 20 days, the Google could have gone up so much that a $2 option, $1 could have gone to $20, right? Could have gone to more than that. So when we look at that, we have to consider all those. It didn't happen frequently, but when it did, it offset a lot of the losers. Okay, So these are the observations. If we, click on it, it'll show you the details. Here's all 420 of them, right? You could tab through them, and what it does tells you, well, if we looked at historically the start date, this was where the stock price was. This is the expiration we're looking at. These are the deltas of the options. This is the strike price. So you could see here that the option started at $1.60, $1.70 was the market. This was the implied volatility of each leg. The stock at expiration was 805. So obviously it didn't go above 840. So that option ended 0. Okay. This option gained 4% and so forth. So now what we have is this historical performance of similar options. Okay, so they have to be kind of in the range, because you're not going to always find an option exactly the same delta, exactly the same distance. But what we do is say, give me options that, we can find options with 20 days to expiration, right? Because then historically we can do that, 20 trading days to expiration. But as far as the strikes and the distance from the stock price, they're gonna, we're looking at a range. So we're not going to look at, 100 delta option, when we're looking at an option, say 15 delta, but we're going to give it, the closest ones that we could observe. Okay. And we could change those parameters, but that's the default. Okay. We could change these parameters up here. So over here in this table, this kind of gives us a little bit of different scenarios. If we looked at it from, well, what if we measured the option from if we bought it on the ask, what if we did it on the midpoint, right? Or what if we created this synthetic option? Okay. So we could compare the returns and the win rate if we change those scenarios. So of course, like if you have an option, let's say here, $2.85 and $3.40. Well, that's very wide. Right? That's a wide market. So if you bought it at $3.40, or you did it at mid-market, let's say $3.10, well, that's going to impact your performance, right? Because you paid more money in the beginning, so you have to have it to go up higher. If you did the midpoint, it's better. So we compared both of them, so you could see the potential difference in returns, win rates, the slippage inside the spread of the option. Okay, so here we see if you did it on the offer, the win rate was 21.9%. If you did it at the midpoint, it was a little bit higher, 22%, which makes sense because if you're doing an option, if you were able to purchase it at midpoint, which is cheaper than the ask, then theoretically, you should have more win rates because the stock needs to increase by less of a percentage. Your average returns compared 15% to 29%. So you could see that the returns were significantly different because you paid less, right? So if you're paying less and it goes up, you're on a percentage basis, you're making more. But now you have a really quick way to compare, hey, well, how much slippage is there in my returns and win rates if I always executed on the market price, displayed market price, or if I got price improvements, let's say the midpoint, which would be the perceived mark to market or fair value. And then a synthetic is doing it a little bit differently and saying, okay, if I created a synthetic option to be more in line with the delta, right? So these are a little bit, the distances away are different, right? Sometimes you're a little bit higher, a little bit lower. What if I created a synthetic option that was more in line with the distance away or the delta, but I based it on what I think the option would be worth based on the surrounding implied volatilities. So if I took the implied volatilities and then said, okay, well, would be the implied volatility of an option that is, exactly 2% away, what would the value of it be and what would it be at the end? Okay, so we could now compare, all three of those measurements. Now, really quickly, I'm not going to take a lot more time, but let's say we decided that I traded this delta neutral. So instead of saying we just bought this option outright and waited till the end of expiration to see how we did, what if we traded a delta neutral, meaning that this option has a delta, right? If you buy an option, it has a positive delta. Well, if it has a positive delta and you want to mitigate your directional risk, you offset that delta by hedging it with the stock, right? So you take the delta of the option, hedge that with the stock, and you held it delta neutral, right? So you started out with no delta. Okay. Well, if you started out with no delta, and the reason you might want to do this because you think the implied volatility is just very low, right? So if it's very low and you don't care, it could go up, it could go down the stock, but you thought the implied volatility was low, so you wanted to initially hedge that delta. Well, if you did that, this shows that the average return was negative, almost 12%, even though the win rate increased 32.6. So your win rate increased, but your average return decreased. And the reason behind that is that you're now have a stock component in there, right? That your win rate increased because if you hedge a call by selling stock, shorting stock, well, when the stock went down, you would have some wins, right, on the short stock that would offset some of your losses. But at the same time, those big upswings, right? If you did those big upswings, you would have given up some of those wins by hedging, right? So your hedge is going to be selling short stock would offset some of those gains in the call because you would lose it on the stock. Another way that is potentially to trade an option is to delta rehedge. So every time the stock moves, you could have, or as options decay, your delta changes, right? So the delta of the option is not constant; it changes as implied volatilities move around, as the options decay, as the stock moves to a different point, your delta changes. So what if you kept rehedging delta neutral at the end of the day? This is what it's doing. It's saying, okay, at the end of the day, wherever the stock moves, I rehedged it. So then at end of each day, I'm delta neutral, and I'm trading the realized volatility versus the implied volatility. Well, here the win rate went up again, 36.2%, but the average return, while better than this middle one, is negative 6%, which is suggesting that over time, this particular option on a delta neutral basis, trading a realized versus implied volatility, the implied volatility tended to overestimate that volatility. Okay, that's what this is suggesting. And if we wanted to change some of these parameters around, we can do that. And I believe you could even download this to start, changing those some of those observations if you wanted to narrow them, if you wanted to just pick certain ones out, you can do that. So well, I'm going to stop right there.
Yeah, we did have a question, D, from a new chameleon who joined today, Michael. He's asking, is it better to set IV range closer to today's value or leave it to default to the wide range?
Yeah, no, that's a good question, and really, it's there's no right answer. You're just looking at it from both perspectives. What if I gave it a wide range? What if I narrowed it? Like, let's say the implied volatility, right, is around 26 right now. So maybe we can narrow it here. Let's say on the low end, I'm going to put 21. On the high end, let's say 27. We rerun that, and then let's see how these numbers change. So it's reloading the analysis. But there's no right answer or wrong answer how you could analyze the data. Is just you could analyze it from different perspectives, right? Like think of it as if I wanted to value a piece of property, rental property, right? And I wanted to compare that property to similar. Should I use, the last 10 properties, the last 15, the last 20? There's no really right answer. You could just look at, all the data to see how it changed. Should I use only the last year? Should I use the last 2 years of data? Should I, so you could see that, should I use square footage or not? So you could see that, when you're looking at the data, you're just trying to get, answers in the picture and the full scope of that data to make better decisions. But there's no exact one parameter or exact way to say this is the best way to do it, and that's it. It's defaults to the widest range in here, but here you could see when I narrowed this down to the implied volatility of the option. So what this is doing is you could see now I have only 139 observations instead of 420. And what this did was look at the implied volatility of the option at the time of the observation and only returned those options that had an implied volatility between 21 and 27.4, which is where the implied volatility right now is 26 and a half. And now we have a different scenario. Right now we have where all three have shown negative returns. Now keep in mind, this is looking from the long side, right? So this is looking at if you're buying the option, okay? It had an 18% win rate, but a negative 1.4% average return relative to, I think, what the original one was a plus 14% return. So that's another thing then to go back in the data and say, well, was there a particular time where the options, were perform better based on those implied volatility parameters? So this gives you the ability to kind of change that around to try to get answers to those questions. Here's another thing, where I'm looking at where if you did you can see this 1.4%. If you bought the option on the ask side, on the offer each time, it resulted in a negative 1.4% negative return on average. But at the midpoint, if you did it at the midpoint, it was a positive 6.9%. So what this is saying is that there's a significance in price execution or price quality, right? If you got better quality executions, let's say you were able to actually get the midpoint each time, right? If you were able to do that, well, all of a sudden this strategy was profitable. If you were forced to get the worst execution at that moment by by getting the ask price, it was a negative 1.4% return. So that's a big, like, think about that's a big difference in your success from loss to profit, from loss of 1.4% to a profit of 7%. So you could see that the quality of execution is very important when you're trading, that aspect of it. You can't just ignore it. And in this case, it was what is that, like over an 8% difference, right? Of between midpoint and executing it, on the market price or the ask price. Well, we'll stop right there.
He's had a follow-up question real quick. He wanted to ask, he wanted to verify that the IV is for the underlying and not the IV of the option.
No, that's the IV of the option. There's no such thing as an IV for the underlying. So keep in mind, the underlying itself doesn't have an implied volatility. The implied volatility is derived from option prices, right? So the implied volatility is derived through an options pricing model, which requires you to put in an option, where option price, days to expiration, and so forth. So the IV comes from the option. There's no stock, the stock itself doesn't have an implied volatility, right? But there's benchmarks, right? There are benchmarks that people use to say, okay, the implied volatility of, let's say, SPY is X. And those benchmarks are usually based on the synthetic constant maturity option with, like, let's say at the money, right? So let's say we have here implied volatility of Google here is 26.6. Well, where's that coming from, right? Where's 26.6? You can't, Google doesn't trade in implied volatility. It's not like a market, like a stock price where we see what it traded at. So this is a derived value. This is derived calculated value based on a model. And the 30-day IV is based on a benchmark of a 30-day constant maturity at the money option, which you're deriving from these option prices, right? You're still going to go get option prices, but what you're doing is saying, well, give me option expirations that straddle 30 days with the strikes surrounding that the money, and then you give them this weighted average, just like the VIX does, and you come up with this benchmark. Okay, so that's kind of like it's might be confusing to people where they say, well, what's the IV of Google or what's the IV of Apple? But that IV is coming from option prices. Okay, it's just there's calculations and benchmarks, kind of, the standard one, the default one is like a 30-day constant maturity, but we could create a 60-day, a 90-day, and so on. All right. But yes, this IV in this range is looking at the option IV.
All right, great job, D. We did have another question Michael brought up, and I put it in the chat. Michael, please email support@MarketChameleon.com with the question. Maybe the question for the SPY that he's asking we can get to at another show. Great job as always, D. You have a great day, my friend. We are right up against the opening bell.
Okay, thanks everyone for joining. Have a great trading day. Stay safe out there. Hope to see you guys tomorrow.
All right, we'll see you tomorrow, D. Thanks so much. All right, everyone, thanks for joining the show. Please like and follow us on all the social platforms. Remember, thumbs up are always appreciated if you're on YouTube. And today we're actually having a live webinar with Ryan Mastro at noon. He's going to look at some different things in the options market. So I'll send out an email with that. You can at noon today for that live mid-market report with Ryan Mastro from Options Robot. Everyone have a great, safe day, and we'll see you tomorrow. Bye.